Learn the essentials about the world of futures contracts in a simple and accessible way with this video. Find out how they work and how they can be used. This simple and beginner-friendly video will be the perfect opportunity to begin your knowledge of futures contracts and acquire the basic fundamentals to take your first steps in trading.
In recent years, so-called derivative instruments, of which futures contracts are a part, have become increasingly important in the financial world. The volume and number of trades have increased exponentially, and derivatives are now traded on all the world's major financial centers. A derivative can be defined as an instrument whose value is derived from the value of another financial instrument or variable. Futures contracts are a type of derivative financial instrument that involve the purchase or sale of an asset at a price set in advance, with delivery and payment taking place at a specified future date. Futures contracts are standardized in terms of quantity, quality, and maturity date. This makes them suitable for trading on a regulated exchange. There are two main functions performed by derivative contracts: hedging and speculation. The hedging function takes place when there is already exposure to price fluctuations of a financial asset, e.g., the exchange rate between two currencies. Another example, a commodity producer might use futures contracts to protect the price of its product from future fluctuations. In other words, one has a risk and wants to protect, hedge, all or part of it. Speculation, on the other hand, can be carried out using derivatives when one has no risk to protect, but wants to bet on the future price variation of a good or financial asset. An investor might use futures contracts to speculate on the future price movement of a commodity. For example, the forward contract and futures contract are used if it is thought that the price of an asset will rise in the future. Through these contracts, we can buy at today's price, but make payment and take delivery of the goods in the future. Or we can sell our contract before expiry at a price higher than cost. If the price is actually higher in the future, we will have made a profit. Participants in the futures contract must deposit a sum of money as margin. This margin deposit is continuously adjusted to reflect fluctuations in the price of the underlying asset. We should not confuse futures contracts with forward contracts. They are both instruments used for risk management in the financial markets, but it is important to bear in mind some fundamental differences between the two. 1. Regulation. Futures contracts are regulated and traded on an exchange, whereas forward contracts are private contracts between two parties. 2. Standardization. Futures contracts are standardized in terms of quantity, quality, and expiry date, whereas forward contracts can be customized to meet the specific needs of the parties involved. 3. Margin. Futures contracts require a margin deposit to maintain the fairness of the contract, while forward contracts do not require a margin deposit. 4. Liquidity. Futures contracts are more liquid than forward contracts because they are traded on a regulated exchange with many market participants. In summary, futures contracts are more regulated, standardized, and liquid than forward contracts, which are more flexible and customizable.
Thank you for watching this first part of our video on the world of futures contracts. I hope it has provided a clear and concise understanding of the fundamental concepts. Don't stop there. Continue your learning journey with the next part, where we will further explore this interesting topic. Stay connected and continue learning with us.